Hello, everybody, and welcome to our first episode of Trade Logic, bridging the gap between smart money concepts and institutional order flow. My name is Andrew Crivero. I am a funded trader with a live trading account with Take Profit Trader. I'm a Pro Plus trader with them, and I have two 50K accounts with Tradeify as well. I've had accounts before with Top Step. I've been funded through many different prop firms along my journey. I can consistently pass evaluations, and I am now in the live stage of my trading. All right, so let's just dive into it. Now, I want to discuss bridging the gap between ICT concepts and SMC concepts into, auction market theory and being able to follow order flow and read a volume footprint, candlestick, and a volume profile. These are the tools that institutional traders use day in, day out to make sure that they're successful. Their win rates aren't at 55%. They have much higher consistent win rates. Why? Because they understand the auction. They can witness the order flow in real time, and they're only participating in good volume, good trading situations. They're not taking poor volume, lack of participation trades. So, decoding the zone. Institutional theory identifies buying and selling zones, okay? Which is essentially support and resistance. That's the retail trap. We'll get into, if you're familiar with SMC concepts, this would be a consolidation phase. You're looking at a support for a floor and resistance on a ceiling. Everybody's waiting for the manipulation and the distribution leg from there on out. Okay. Limitations: fails to show current aggressive participation or market maker passive absorption. Excuse me, messing up my words here. I'm relatively new to this, but so the tape reality is that order flow shows the actual auction, the transaction volume, who's winning, who's losing. Sometimes, as we will get into, candlesticks appear to show bullish or bearish order flow, when in reality the auction and the volume profile and the volume footprint are saying something totally different. And that's where you'll see consistently a lot more traders nowadays with AI algorithms coming into this space. They're making fast executions based off of, a news headline or VWAP. The AI algorithms are constantly using the volume profile, value area highs, value area lows, VWAP, point of control. These are things that will trigger an AI algorithm to, take on a large position or multiple small positions. They could be acting in the consolidation phase. And without this participation, we don't want to dive into the trade. But this AI algorithms are consistently why you will find your inversion fair value gap trades failing all the time now. Okay, and I used to trade IFVGs and SMC and ICT concepts exclusively. That's where I began in my journey, and my profitability and my success definitely became so much more consistent as soon as I incorporated order flow and auction market theory to my already established education of SMC. So, moving on. All right, here's an example of what you would learn through SMC and ICT concepts, okay? So we would see Asia session, we have established a range. Now you would want to see London manipulate the highs or the lows of that session. And we're all taught that open high, low close, open low, high close. So Asian session, midnight open, London manipulates the highs right up here. We distribute down. We go ahead and New York, we swept the Asia lows and consolidate prior to the New York Open. All right. So New York Open, we dump off bearish. Most traders would think they're looking for continuation shorts at this point. All right. Even myself, prior to incorporating order flow in my trading habits. So traders would see this and they would, mark out a order block or a breaker block. They might like the fair value gap, the first presented fair value gap up here as a confluence. There's so many different confluences that you could pick inside this little piece of consolidation here for what is going to be your confluence of choice. All right. So in this case, you see that price traded right back up into that order block. A lot of people, I'm sure, were taking shorts off of, you know, the first, if this is on a 15-minute time frame, if you were to zoom down into a 5 or a 3, 2, 1, whatever, you're going to find a fair value gap in this leg somewhere. This right here, this is an aggressive little punch up into that order block, this candle. I'm willing to bet you there's a 5-minute or lower fair value gap resting right underneath that or in that bullish candle leg. So tons of traders would be hopping on shorts directly off that inversion, targeting these lows. Even though we see obvious absorption, some people might catch on to that and say that shorts aren't the move today, but a lot of people would be hunting continuation shorts. Okay, all of those people got their boots smoked. They all lost some money that morning. They definitely either took break even or full stop loss. I would imagine they took break even after we swept this low right here and had a change in the state of delivery. Although, moving on, I don't want to stay stuck on slides. Now, this is going to look like gibberish to anybody that hasn't dabbled in order flow yet. All right, these are volume footprint candles. I use these day in and day out. I do not stare at these during the regular session until I'm ready to take an execution. So I'm still using SMC basics for my analysis, and I still form conditions, what I want to see. All right, I could say this breaker blocks my condition, and ideally I would want to see a rejection off of that breaker block and an inversion, but without order flow, which would be a totally valid trade idea, except if you zoom into this volume footprint profile. All right, this, again, gibberish at the moment. This yellow line in every candle is called the point of control. You'll find that on a volume profile as well. If you're not familiar with what that is, that means that was the tick level where the largest volume of trading happened, okay? Where essentially that's an agreed upon price level where there was a lot of the most participation within that candle. So that is significant, and it can help you understand what direction we're headed. Pair that with, you will notice these highlighted lines right here, okay? You can go into your settings for your volume footprint. I'll share my personal settings on the Discord so that everybody, if you're interested, you can go ahead. If you use TradingView, I'll have a screenshot of my settings in the tools of the trade section. The Discord, you can find in the link in my YouTube page bio. Completely free. So go ahead and join up in there and get yourself some knowledge. But these highlighted zones are basically an imbalance, meaning at that tick level, there was at least 3 times the buying pressure than there was the selling pressure, because in this case, it's a bullish candle, okay? So we have, this is institutional participation. These are large orders, or somebody with a heavy bag behind them that's just throwing money into the market that day. I mean, there's heavy hitters out there that aren't institutional traders, but we want to take trades with either institutional participation or participation of people who have enough capital to move markets. All right, we want to hang on to their coattails, let them drive the vehicle. We just want to ride passenger. So I would have already seen in this volume footprint this bullish stride running up into this order block with us printing and respecting these, what I would call a buy pad. That is a buy pad. If it was a bearish candle and we had a bunch of levels of imbalance on a bearish, with basically there's far more limit orders on one side or the other, either buying pressure or selling pressure. Okay, so in a bearish candle, it would be a sell pad, and in a bullish situation, it's a buy pad. So if you see this first candle punched up into that order block, and then we had massive absorption right here, meaning shorts came to play. They were loading market orders that were absorbing a ton of these bullish limit orders, and or just market versus market, but either way, we have bullish absorption. That candle wicked right up into that order block and it punched back down. But we see that the candle still closed above the point of control. Bulls are still in charge here, all right? We haven't turned bearish, but this could be super confusing to somebody who doesn't understand order flow concepts. Okay, next candle opens up. We immediately have this buy pad gets respected. A lot of times you will see price dig back down into this buy pad and potentially go for this one unhighlighted level of imbalance here. That's kind of a draw on liquidity in a very, very short term. So I would have wanted to see price dig down into that level and respect it, and then turn around and turn bullish again and close above the point of control. And you're pretty safe to take longs at that point with your stop loss below the previous low. All right. Now, we see that regardless, I would have my breaker block as my condition, or order block as this condition. So we still have some choppy price action here. There's other confluences on the screen. Down here we have what's called these highlighted boxes. This is a table that represents everything happening within each one of these candles. The green and red boxes are the volume delta. All right, so as this auction is happening in real time, and there's a tug of war between bulls and bears, buyers and sellers, you could have a blue candle, bullish candle on my chart. I like them blue. If you have a blue candle with a red delta, that's a sign that we're going to flip bearish, okay? That means the delta is the difference in leftover orders. If the auction closes for that candle and we have a green delta and it's a bullish candle, there was that many more bullish orders left over from that candle, okay? Participation was on buy side. Now, if we have a bullish candle that closes with a red delta, now we're waiting for confirmation shorts coming out of there. I'm waiting to see levels of imbalance on the sell side. And once I have at least 5 levels of imbalance with my sell pad get respected, that would be my confirmation to take shorts out of this range. A lot of other people, not so much. They can just see, you got people like TJR out here teaching the public how to lose money regularly. It's just tap into the gap, and if we respect it, it doesn't work. It's not a realistic model. You won't be profitable. You won't remain consistent. You won't be able to get yourself into a live funded account. You might get funded and then pop an account because you just got lucky on a couple trades. But to remain consistently profitable, take payouts, get into a live account, you got to know what you're doing. You need to combine behind the scenes order flow with your already established analysis. These guys are teaching you half the puzzle, which is awesome. I'm not trying to knock anyone. I just mean that people are charging huge money these days for poor education, in my opinion. I'm not looking for anything from you except for to see you succeed. So, in this case, I would have seen price, again, get absorbed. Other people might see that point of control right up here at the top of that absorption wick. Candle closes far below it in that order block. And this is everybody who's just assuming we're taking shorts out of this zone. They're loading up market fills for shorts. All right. And they do establish a little bit of selling pressure. Price does come down. But if you notice, we don't have massive groups of imbalance highlighted. All right. There's no large imbalance legs sticking off these candles. And at the same time, the point of control, all except for these 2 minute candles over here, the point of control is remaining at the top of these bearish candles, showing there's a large fight happening behind the scenes in the auction. All right. And what do we have right here on this bearish candle? Directly below it in its table, we have a green delta. Sure sign. This is a fake out. This is manipulation. We aren't going to actually flip bearish here. We might be balancing this range and people are just misunderstanding it. But this is where institutions grab you by the seat of the pants. Next thing you know, you're at break even or stop loss. All right. So I still would have been patient in this case and scenario. I would have been sitting. And really, if you're an inversion trader, This is the inversion you want right here in between this established wick and this established wick. We still have a bearish fair value gap right here. And then boom, now that's displacement. Large imbalance, point of control. We're right back up into that order block. As soon as this candle opens up and it's holding its position, that's my entry. I'm in. Stop loss at these lows, or even, to tell you the truth, 9 times out of 10, my stop loss is below that buy pad. I would much rather have a higher R, lower risk, because if my trade idea is correct, I don't even need to put my stop loss all the way down at those lows. SMC will teach you to reach far and wide and place a stop loss a lot farther than it needs to be. Institutional traders are going to keep their stop losses tight, a lot less risk on the table, trying to reap a high R reward with a higher win rate too. Right now, I've been maintaining anywhere from a 65 to a 75% win rate with an average of 3.4 to 4.5 R. That's incredible. You know, that's really good. I'm not trying to toot my own horn, but it's a lot of hard work, and this is how you do it. So, boom, you could take longs right there, and then what do you know? Next candle opens up, huge participation, bang, and the chart skyrocketed immediately after this. Okay. So that was just a brief walkthrough on how to read a volume footprint. We will go more in depth into that on a live chart. So volume profile mapping, the institutional auction. If you're not familiar with a volume profile, we will definitely give a chart example of that. But on a structural basis, it maps the potential support and resistance using swing highs, lows, pivot zones, and price action. So at New York session open, I personally won't take a trade prior to 9:45. Those first from 9:30 to 9:45, I'm mapping out the volume footprint. I also have an indicator in the background that is mapping out the entire day's volume footprint, the entire trading day. And whoa, I don't want to overwhelm you. So for right now, great way to start. First 15 minutes of a session, and you will see for yourself if you throw a volume footprint on there. And again, I will screenshot my personal settings because I do have some tweaks on mine, and I will have those in the tools of the trade section, completely free in our Discord found in the bio. So let me finish this up. The catalyst, it identifies order blocks, fair value gaps, and 3 theoretical areas of institutional footprint that are actually going to be valid in your trade, that will actually hold and not just fail. How do you determine which ones are valid and which ones aren't? Order flow, auction theory. All right. So that's where you make the moolah. But the draw on liquidity targets are based on visual liquidity, where liquidity is resting. I know that everyone just makes assumptions where retail's, and we're really good at it. If you're an SMC trader, we are good at distinguishing where retail is placing their stop losses and where retail is placing their take profits. And we all are retail. If we're not in the bank trading for the bank, you bet your butt we're all retail. There's just people who are really novice retail traders, and then there's really experienced retail traders. I like to think that I'm a professional retail trader is the best way I could put it. So we would look at the volume profile. We're going to see retail. Stop losses are clustered, and you'll see that on the DOM, the depth of market. All right. And the weakness, it assumes a zone is valid based on its shape of the chart, regardless of whether actual buy and sell orders are present today. All right, so we could just assume a zone is valid because that's what we're taught through teachings, and for years and years and years with better market conditions, they would play out. We're dealing in a new day and age of markets. That's a promise, and it's not going to get easier. It's only going to be harder. So unless you're using auction market theory and hopping in the vehicle of the car with the driver, you're really going to have a struggle rolling through and trying to do this successfully. It's almost impossible. It would be sheer luck if you were able to. So order flow reality, volume-based value. Logic, order flow maps the institutional auction. We can view it. We are seeing in real time. Defined by real contracts traded at every price level. That's going to be labeled on the depth of market. You're going to see on that right hand side. We will also do an example of how to read that. I will pull up my live account tonight and I will show you the depth of market in action, and you can see all the resting orders, and we can see where a large amount of them are and a large on each side of the aisle. So draw on liquidity. The real draw on liquidity is determined by value, volume, point of control, and high volume nodes, not just price high and lows. This is very important to understand. Once you spend a little bit of time getting educated in how this works, it's going to become very clear to you. Refinement distinguishes between areas where big money actually participated, a high volume node, and simply empty levels, low volume nodes. Where you see low volume nodes, I will get into that, you're going to find a fair value gap or something, breaker block, a large area of displacement. Those are the next target. Those are your internal range liquidity. Say we just swept an external range liquidity high or a low, and now we're going to target internal range liquidity, a 5 or a 15-minute gap. If you trade PB, the MEC model, which is an awesome model, if you were to target one of those internal range gaps, where you find a low volume node on the volume profile is exactly where institutional traders are going to drive that car back to. So you might have a stack of fair value gaps. So this is how you're going to determine which one is the one that you are going to target. So analogy, it maps the traffic flow value and it follows volume. All right, so here's an example of an inversion that would just completely fail. That's a valid trade. All right. Again, I think this is the exact same chart that we were looking at. Instead of mapping the breaker block up here, right now, people could have been taking inversion longs. We dumped out of the market, and what do? We just stop raid immediately. It sucks to see this happen. I'm in a couple different discords, and I watch some guys struggle to maintain profitability, and they're facing stop raids and yada yada yada, and it stinks. It sucks to watch. So here I am. But right here we had a bearish fair value gap, and this is on a 5-minute time frame, so totally valid inversion, right? So we inverse a 5-minute fair value gap. I know that we're trading up into one, but that's a strong leg of displacement. Back when I was trading inversions, I would have taken this without a doubt, and I would have gotten murdered at my stop loss. There's no time to go to break even here. So your entry, you're done. That's it. Immediately into the red drawdown. So, and that sucks. And where do we go? Right from there, we turn right back around and we go to full TP. This happens all the time. And you would have been able to realize that this was not a good trade by looking at that volume footprint. If you don't have large areas of stacked imbalances, we do not have large participation. The volume has not touched the tape yet. Institutional traders are still sitting sideline, and they begin participating through here. All right, they came in later. Now, this is the exact same trade idea, but looking at it through a different lens. So we could have already been anticipating this inversion, and we would have wanted it to take this trade. And we could have been now zoomed in to the volume footprint. You don't have to change anything about the way you trade. It can still be all the exact same analysis, but you're going to be much more snobby about which trades you take now. So you could be here watching this inversion, large legged displacement, no real imbalance levels highlighted off here. I have my settings set to only highlight areas of 5 or more imbalance levels. Anything less than that I don't find to be really structurally sound. So we have SMT. We also have, this is called a CVD divergence, cumulative volume delta. It is also measuring the delta, the remaining shares in the candle after it's closed. And it is letting you know, see right here, where it's measuring the volume of participation. So on this histogram down here, that's what this is called, is a histogram chart, is we have red candles digging deep in this bearish price action, showing massive bearish pressure. A lot of people would see this huge displacement leg, again, looking for either continuation shorts or this heavy bullish reversal. So continuation, neither one were right. If you took continuation shorts off of this inversion, you are also getting stop rated. If you took longs off of this inversion, you were getting stop rated. Some of these days really stinks. Some of these days really stinks to be sitting here participating in the charts, and you can easily go on tilt, blow up an account very fast. Excuse me. So, bullish CVD divergence is when the histogram, the volume could create a higher low or relative equal lows, and price reflects on the chart a lower low, or it works in the same fashion with a higher high. If the volume, if we have bullish volume, just kind of peak right here, and or say we saw bullish volume rip up right here with little reflection on the chart, and then we have another bullish candle that pokes up, prices making a higher high, but the volume candle is showing a lower high, then you know, and we would have a mark show up on the chart that is a bearish CVD divergence, and we're most likely going to flip bearish. I find these to be more accurate than SMTs. I still use SMTs as a confluence. They're a great confluence. So if you see these paired together, you know, which in this case, bearish SMT, bullish CVD, which one won? I choose the CVD every time. A lot of times SMT fails. They're not always protected. This is more protected than an SMT in the case that you see this, witness this, or you witness this. This would be a protected low versus this protected high. So moving on, all right? What do we have also in this bearish leg coming down? Bullish price action. It's hard to tell because this image is a little zoomed out, but I tell you right now, one of these bearish candles absolutely has a bullish delta. So first indicator, CVD divergence. Now we're just waiting for our imbalance levels. First candle opens. This is how people bottom tick and top tick. So CVD, order flow flip, imbalance levels. Next candle opens up, and I'll be doing this on the 30-second chart, getting in super low or super high, and I mean very discounted or very premium. So this candle opens up, holds those levels, bang, that's my entry. I don't need other confirmation. We are not tapping back down into these. We're not digging. We're maintaining a bullish delta. You know, in this case, yeah, I believe we are. We're maintaining a bullish delta these first two candles. Yep. And then we have a small bearish candle, boom, and it just continues on. And we see imbalances. And as I'm going, I'm trailing my stop loss from buy pad to buy pad to buy pad. I'm in break even way faster than majority of traders. If it runs back on me, who cares? I'm leaving with a profit. Whatever. I'll get another opportunity. I could get one right here. This provides you too with a lot more opportunity within your day for continuation trades and so on and so forth. I don't want to get stuck on a slide too long. So next slide. This is a volume profile. All right. Right in here, I marked this box. And if you look at this is also a histogram chart. That's what that's called on this side. So we have, you know, a much darker area of the histogram chart on the volume profile and a much lighter area. And so what this does is it automatically will highlight for you where 70% of the trading happened, which is inside of this area. So there is a purple dotted line coming from the separation of this high value area to a low value area. And there's a purple dotted line extended across my screen. That is value area high. And this is value area low. And what do we see price doing? Rejecting the value area high, rejecting the value area low. These are pivot points for institutional traders. If you notice that your value area high and your value area low lines up with in this low volume node, we're going to have a, you know, you could have ran off this breaker block, or that's not a breaker block, I'm sorry, but you could have gone off of, there's definitely a nice healthy fair value gap inside here. So that's your one that is going to be more accurate. You could mark this, I call them areas of demand when they are on the buy side, And if we were on sell side up here, these low volume nodes, these are also low volume nodes, are areas of distribution. So I'll mark those boxes differently. I will call them AOD, or they're both AOD, area of demand or area of distribution. Sorry. I'm the smartest stupid trader you'll ever meet. All right. So here we go, where this is a high volume node. Okay, these are low volume nodes. The histogram wound up tight, and there's little participation in these areas. And then this is the area with the largest amount of participation. So this is the area where you're going to find consolidation right here, consolidation right here, consolidation right here. This is the point of control. This is where the most participation happened in this trading leg. So that would have been during Asian session overnight. And you see tons of consolidation all through that session right here. And this, we closed with, this would be called a P shape. So we were bullish rolling into London session. And then where did we target? The low volume node. New York dumped off into the low volume node. What also ran through that, this orange line, is the volume weighted average price. I don't care for EMAs, SMAs, all that other jazz. I don't believe in it. I think it's garbage. All right. All that stuff I would take right off my screen. It's just going to confuse you. MACD, all that stuff. I, again, started my trading journey a couple years ago using MACD and RSI and all that jazz. It doesn't work. It doesn't work. It's trash. So throw it away. This is all you need to know. You just need to replicate how institutional traders trade. If you can participate in the exact same fashion, you can hop in the vehicle that they're driving and ride passenger, and you'll have a good journey as long as you're disciplined. So low volume node, area of demand. In New York session, we opened in a premium. London session drove price up from the midnight open. We're in a premium beyond this value area high. So we're up in a premium now. Before New York open, we see price dump down. If we have any optimal trade entry traders in here from ICT, this right here was your signal. This distribution leg, this was at what, 3:30 in the morning, in the kill zone too. So here we go, large distribution. It retraced back up 60 or 70%. And then that's a healthy return right there down to that area of demand, or you could just target the volume weighted average price. Very accurate. Institutions use it. So now we took out Asia lows from here. Institutions hopped in. We're at value area low. We're now discounted. They are looking to jump in. We have consolidation at the value area low. That's your signal. Bears have lost control. We're consolidating. They're growing weak, running out of steam. Now we just need to see order flow flip. And with imbalances, that's our cue. Enter, and you could build a position on the way up, or you could start with a decent sized position to begin with, whatever floats your boat. So see that imbalances, you would hop in, trail your stop up those buy pads the whole entire way. You're going to capture good gains. You could have your take profit set at the value area high, or you could have it at the point of control. We are likely to consolidate at the point of control every time we visit it. So it doesn't always happen, but there's a high likelihood. A lot of time in my trades, I will just target the point of control because I know it is super likely that we're going to make it there. We don't always get to the value area high. All right. So whatever you find works best for you. Now, delta divergences. We went over these briefly, but they are super important. Retail observation. The chart forms a trend line break or a standard range breakout pattern. It is not SMC. I'm sorry, I was just lost, going crazy, filling out all these slides. So that is just regular retail strategy, opening range breakout strategy for anybody who trades that, which can be done successfully as long as you do it with order flow. Opening range breakout strategy without a volume profile or order flow, you're not going to catch good breakout trades. You're going to be stuck in the manipulation. So price moves aggressively into a theoretical liquidity pool where retail stop losses and breakout entry orders are clustered. Exactly what we're taught in ICT: accumulation, manipulation. This is the manipulation. So the assumption: retail enters a breakout or breakout trade, assuming that momentum in the trend will continue in their direction. We know all about this too well. All right, they punch it up. They are putting price into either a premium or a discount from that accumulation zone where institutions have been loading up their fair share, and they're getting one final big boat load up before the distribution leg occurs in either the upside or the downside. All right, the analogy: they are the first ones to enter a store when the doors open, only to find that the merchandise is gone. They are the trap traders. Tons of trap liquidity up in that manipulation leg. They're all getting stopped out, or they are getting a margin call, whatever it's going to happen to them. They could be blowing an account, yada, yada. So, order flow rejection. All right, institutional execution, the aggressive retail flow. The breakout is immediately met with passive institutional limit orders. You'd be able to see that on the depth of market. You won't be able to see that unless you're running Bookmap or reviewing your depth of market. All right. And unfortunately, a lot of times with regular funded prop firm accounts, you can't actually view the live transactions on the depth of market beyond the bid and ask. If you have a live account, you're lucky, you get the full data, and I will show you guys that. So institutional execution, the aggressive is met by passive institutional limit orders. The rejection, the tape shows aggressive counter delta, the CVD divergence that I told you about, or the volume footprint candle. Either one. They could have a huge bullish candle manipulating higher, closes a bullish candle, closes with a red CVD, bearish CVD. I'm now waiting for that flip in order flow, and I'm gonna top ticket. Everybody else is sitting there entering so much lower at the first inversion or something, and they might be right about the trade. It could still pan out, but why wouldn't you want to top ticket if you could, right? Why wouldn't you want to get in there way earlier with less risk on the table because you're a lot closer to your area where you're going to place your stop loss, or a much shorter distance, so you could have far less risk on the table and catch much larger risk to reward trades. I'm a big fan, as you can tell. All right, we love the money. So the rejection, the tape shows aggressive counter delta. A buyer's market breakout is met by an overwhelming wall of institutional sellers on the depth of market. What does price do after that? It takes a shit. All right, goes down. So the tape confirms that it's not an SMC breakout, it's a retail breakout, was a liquidity capture event. Institutions use the aggressive retail to fill their massive sell positions without moving the price yet. The analogy, they are the absorption point. They are getting absorbed. All of the pressure they've created is getting met with institutional traders or large position players that are taking those shares. They are trading them. This is, in fact, a trade, and they are on the losing end. They are stuck liquidity. They are screwed. That sucks. You don't want to be that guy. All right. So I'm sorry. I know that slides are definitely not as entertaining as looking and reviewing live price action. We will absolutely be doing that, but you should know this stuff before we do that. You'll understand how I think, what I'm doing. Okay. So here, all sorts of shitty looking price action. And on days like this, most people will be like, I'm not even going to trade. Fuck this. And I don't blame them. Excuse my language. I'm sorry. I should have gave him one of those, you know. But so either way, price is consolidating. Super crappy price action. I've got aggressor bubbles labeled here. The aggressor bubbles are showing. We've got, this is your trapped liquidity. All right. So I see this. Other people are saying, I'm out. I'm not taking this. And you're right. I'm not taking any of this, but I am anticipating this because I already see this. This tells me we've got trapped traders on sell side. So, and bullish CVD, choppiness, bullish CVD. No massive imbalances. If I was to zoom in on the volume footprint, I can guarantee you with these small of candles in this price action, wicking up, wicking down, all this is, it is crap. There isn't going to be large imbalance levels that held, okay? We are just consolidating at the volume weighted average price. I'm willing to bet you too, if this had a volume profile on it, you will see we're probably right on the point of control. This is where we're going to consolidate. We traded down to it, and then we're going to trade away from it. We're going to expand from the range, and we're going to seek external range liquidity, and then we'll come on back for internal range liquidity. So bullish CVD divergence, trap liquidity. I would now be in my volume footprint. I see this. These are my couple confluences that have been met. We also could be tapping into a large fair value gap. A lot of the confluences that we use are still valid, okay? If you see a 4-hour gap that you're anticipating price to draw down into, and you just want confirmation that your trade idea is a good one, you could see that massive level of imbalance take off, and you could have your histogram down here for your CVD divergences reflect with, you know, a candle of the same color. We now have bullish volume present, and bearish volume is growing weaker. All right. So, and we're getting all of these CVD divergences. Okay. Price is making higher highs or higher lows than the volume delta. This is very accurate. Auction market theory is no joke. It's real. It works. So we would have seen here, see these aggressor bubbles? If you were to pair that up with the volume footprint, here is your imbalance levels. So I would see, boom, we rocket up, displacement, imbalances away from volume weighted average price. Next candle, we have bearish volume and aggressor bubbles showing, but we see little reflection from price. It is holding these levels, and volume is also showing that. I'm there. Boom, in long, and my stop loss is going to be not down here, not all the way down here. I'm going to have a bigger position size just below the buy pad. All right. If price disrespects the buy pad, I'm out. The trade idea is invalid anyways. What do? Rocket it away. Okay. Institutional traders are not using SMC or inversions for entries. They're not. They're using volume profile and pivot points and order confirmation. So the SMC kill zone windows. The windows identify high probability setups, the distinct Asian, London, New York session kill zones. Everybody knows this who trades SMC. These are some of the core values. All right. Time aligns with price. We need to see both aligned for a valid trade idea. We're not going to have a lot of participation outside of the macro windows. So the zone, price must be trading within a higher time frame point of interest or a liquidity pool. We want to see price has traded up into a 4-hour or higher time frame narrative. And then we're going to have, we have the where and the when, but we are still missing the who. So until we see the imbalances, we don't have participation. We don't have a trade. It will most likely fail if you take one prematurely without the active participation. All right, the wait, no footprint confirmation, no trade. We do not limit order into zones. We wait for participation. So we don't. I don't place limit orders at fair value gaps, hoping that a wick might rip down and fill me, because I've had way too many times in my early trading days that I would see price wick on down to fill me, but then punch right back through to where my stop loss is. So I do not enter until I see imbalances out of my confluence zone. I'm running my checklist. I want to see a CVD divergence. I want to see an SMT divergence. I want to see these are just multiple confluences. Of course, we all need to be dynamic. No trade is perfect every single time. You're not always going to have a CVD and an SMT and imbalances paired, all of these things in a perfect world at a value area low or a value area high. That's an A+ setup. If you see that, you go high risk. That's very, very likely to pan out in your favor. Rare, super rare. I might be okay with just the SMT or the CVD alone, plus the imbalances. The main thing is the imbalances and holding the imbalances, okay? And seeing the volume footprint and the volume delta paired with my my trade idea. All right, so this is a trade that I would have taken. A lot of people would have taken these longs. All right, later on we'll get into these are fib levels. I have a Fibonacci with specific settings for opening range breakout patterns that I will also screenshot the settings, and I will put them in the tools of the trade section of our Discord. It's a great place for resources. If you want to ask me a question, anything like that, you can just hop in the chat and you will get a response from me directly. So dumping down at New York Open, so many traders going to be jumping. There's a very small fair value gap right here. Tons of traders taking this inversion. Boom, they're right in. What do? They get fucked. Okay, they get screwed. So price rips right back down, takes out this low, and they are smashed. And that stinks. Nobody likes that. I swear, is YouTube gonna ruin this on me? I hope not. I don't mean to be swearing. I'm still new to the YouTube. I'll stop. So price dunks down, takes out this low. Anybody that participated in this trade prematurely, they did not hit their TP, they got stopped. If they were taking longs here. So now I would have noticed, what do we have here? There's definitely a CVD divergence. This is super zoomed out, so it looks horrible. But if we were to zoom in, one of these candles is going to have a delta divergence. I'm sorry, not a CVD. A delta divergence, meaning blue or green candle with a red delta, or a red candle with a green delta. And that's going to be a delta divergence. I want to see a delta divergence paired with either a CVD or SMT divergence. Then I want to see imbalances. That's the final step to my entry. There's 3 steps to this. And then you trail your stop, buy pad. Okay? You have your target. Where did price go? It retire. But either way, first trade, price comes up from this pivot point. Institutional traders took a piece here. They drew price back up to this value area low on this. There's a volume profile up here out of the view. So this is the value area low. From the value area low, we rejected. Tons of people would definitely be taking continuation shorts right here. And if you were targeting these lows, you hit full TP. But very small trade. Most people would be targeting deeper. They're probably going to get stuck too. So aggressive flip, very aggressive flip. I would see my delta divergence and paired with massive imbalances after just sweeping this liquidity pool right down here. And I'm willing to bet you, if I had the histogram up, there is going to either be a CVD divergence, or if we were to compare this chart to MES, this is MNQ, by the way. If we were to look at MES, the 2 correlated assets, you are going to notice that there was probably an SMT as well, showing a weakening in pressure. So imbalances, candle holds, a little bit of a retracement. I don't really care. I would have entered either here or at this retracement and saw it weak with the retracement. Boom, I'm in. Then stop loss starting below this buy pad. I don't want to see price come down to these levels again. If it does, we're going to have continuation shorts. At that point, I want out. I'm good. My trade idea was wrong. So price respects those levels, pumps up. We have more imbalances, even more participation. Right there, I'm past break even. I'm already in profits. 10 minutes into the trade. So, and even too, I take a lot of 30-second chart trades that are pretty quick. Within a 5 or 10 minute period, I might be out. I'm done. So either way, trailing my stop, buy pad. As soon as we form this low, you can also hop right into SMC style trailing. You could have your stop at this low now, waiting to see price. You could be targeting the value area low, these highs, or I would have been targeting the volume weighted average price, or realistically the line is so faint, and I'm sorry, these slides were already created. But very faintly in here is the point of control. I have an arrow ripping to it. If you were to place your final TP at the point of control, we pretty rapidly and aggressively rolled right up to it. So that's awesome. That's probably, if you realistically look at this, it's like a 5-hour trade, and you bottom ticked it. You got in way earlier than anybody who was trading the inversion. They might have got in up here, which is cool, you know. They would have seen the candle right here close inside that fair value gap, but I'm already in it. I trust that we're going to inverse this fair value gap. I know ahead of time. Next candle closes up here, you might be entering here. Now you're just looking at a 1-to-1 when I'm getting a 5R. So, moving on. All right, risk architecture, sizing on value. Traditional dollar-based stop, SMC. The approach, calculate the position size by a fixed dollar amount. The risk at 1% of the account. And a random point-based stop, meaning a low or a high that you believe is protected. Okay? Retail places their stops at arbitrary charts, high and lows, assuming that it is support and resistance without defining the actual trade volume at that level. We are all retail. I do not think I'm better than anyone who I am referring to as retail. This is a dollar first risk management. Stop is set by the stop is set by, I gotta move my head here, what you want to lose, not by the market weakness. Not by the market stop. Not by the market weakness. The arbitrary stop often lands inside of a high volume node, leading to constant stop outs before the real move happens. I don't take trades from the point of control. I don't like that, because if you take and a lot of people don't realize they're even trading in the point of control, but everyone who's an institutional trader is sitting there with that on their screen, and they're aware of it, and they're accumulating positions. So wherever you see accumulation or chop, you're likely at a high volume node area, and institutions are manipulating price back and forth to be able to keep loading large size positions. If they want a position of 100 micros, there might not be 100 micros on the table to purchase right then and there. I'm sorry, that's a bad example. Okay, they'd be an NQ. But if they wanted 30 or 50 contracts, you know, they're gonna have to buy it in pieces. So, and they want a good fill price, so they're going to manipulate price all around or wait for traders to bring it back down. They're buying in bits so that they're not disrupting and causing displacement immediately. They're going to have their full position size that they want at the price range that they want, and then they're going to watch price expand the range. I like trades that are back to the point of control. External to internal is my favorite. I find those to be far more successful. So, order flow, value-based stops. The approach, define the high probability invalidations first based on the volume profile and the DOM. Pretty much everything we've been going on about. Massive imbalance levels. If you had an inversion with a lot of imbalances in it, you could still trade inversions if you like, and you're married to that. That's fine. If you have imbalances paired with that, you're going to become an assassin. You know, your trades are going to play out way more. Your win rate will definitely increase. You'll be taking a lot less of those crappy examples that I showed you where there wasn't active participation yet. And you'll be stepping in on the ones where the big players are swinging. Logic, map out the high volume nodes and the volume point of control. Position your stop outside of the acceptance zone or the buy pad or sell pad, my slang for it. The stop is defined by actual transaction data. It's not just an arbitrary stop. I am placing my stop at specific levels where price is likely to respect if I am correct about the trend change. I don't need to have it all the way at the low because we are not returning there before going to my take profit. So expectation, this method defines professional risk first, maturity if value breaks, the trade is dead regardless of the profit and loss. Now, back here, what do we have? Exact same trade example. We're not going to go back over this, but this does just cover everything that we touched. Huge imbalances, yada, yada, yada. So, account parameters. This is your maximum risk per trade, 1% of capital. I personally really like one, in these war headline news that we're getting right now, I'm so risk off all month. I'm real happy with across 3 accounts. If I'm just taking it $500 a day or $750 a day, that's great for me. Consistently winning. I could care less if it's 200. That's an awesome day. I'm at 0.25% risk right now. I just sized up last week when we had all the news, expecting bearish price action after the ceasefire agreement didn't pan out with Iran, and I anticipated charts to pretty much gap and crap, gap open and crapshoot all day. It was the polar opposite, complete opposite of what was anticipated. The blockade really reinstilled bullish price action and confidence in the markets again. So I was wrong about that. I sized up and I got stopped out with a very tight stop loss, but I'd still immediately in like a second lost like $500. And I was like, boom, okay, slowing it down. So I'm back to 0.25% risk. I already made all that back, by the way. We are green on the week. I think only about like $500, nothing crazy. But the week ain't over. All right. So I've had a very good month. The floor is yours. Real quick, we will just touch base on live chart example. I would like to show you the actual depth of market in play. So right now, this is the live chart. I've stripped a lot of the indicators off because I don't want to confuse everyone. If you look at all the mumbo jumbo that I have going on prior to just, working on understanding one of my indicators at a time, then you would be so confused and you'll go nuts. But when you have a live account, this is my live account, the depth of market has all this data. And what do we have down here? All right. We got 40 contracts resting and building. So that was 30.96. Boom, 41. All at 26,435. So 26,435. What do we have right there? And I bet you we were to come in here. Get this ray tool. 46.35. So we're not far off where we are right now. But I tell you what, you can look at this depth of market, and it's very simple. You can look at the histogram levels right on the side. Who do you think is going to win this fight? I'm assuming bulls. We might be bearish for another minute or two to retrace back into this gap. There's big players down here, and they're waiting to drive price higher for London. They are letting shorts take over for the time being. 3 orders, we're just going to chop around. Minute order scales, eating each other up. Shorts are still loading, hopeful that they're going to diminish the buy side pressure. We're building even larger positions here at this level. So price is likely to return here. The market is going to want to be efficient and balance price down to this level, fill up these orders, and we are going to take off from that level. So this is what I mean by depth of market. I don't necessarily place my orders on the depth of market. I just use it for insight as to where the trend is going to go. I still like to place limit orders, really market orders defined by a project order, and then I can just execute. Bang. Good. All right. A lot of times I'm moving so fast that I don't even place a stop on the chart. It's fine. I place my stop after. When you trade like this, I don't get stop rated much. Sometimes I do. Sometimes I'm wrong. I'd be lying if I told you I don't. But it's a lot more rare than when I was trading inversions. I'm content opening my position without a stop, being reactive to the market conditions. I want to get in there before I lose my opportunity. So I get in there and I worry about placing that immediately after. If I notice price draws right back into the zone that I don't want to see price at, I can just simply close it fast and I'm out. All right. But so now building back my indicators. All right. So what are we looking at here? Price came down and touched, if the volume weighted average price adjusts itself based off of how much of the chart we have on our screen. So let's show this range that we just had. I am expecting we're going to balance this range at some point, okay? We have a lot of liquidity resting throughout these areas, and my guess is we're going to wick and sweep these areas. I don't know when, but in due time, soon, probably next week, or maybe by the end of the week, we could have people with very bearish sentiment on Thursday and Friday in fear of holding holding positions over the weekend with, we've already received threats that there will be retaliation. I mean, this is just stacked session liquidity, stacked. So I anticipate there will be some bearish price action. What goes up must come down. We have been so bullish, but until we get full confirmation of that, I am bullish until proven wrong. All right. So you can use volume weighted average price as a confluence as to where you believe price is going to visit. So we have, these are lining up. Sell side 5-minute relative equal lows. If I got on my zoom down in here, right here, common level that you're going to see price. I use an indicator to mark whenever I have relative equal lows or highs show up on my screen, and you see them consistently get disrespected. Price wants to come back down to those levels. So what may have been resistance once now becomes a target. Moving on. All right. So these are the indicators that I like to use. Okay. So session volume profile HD. I will even pull up my settings real quick on this. If you want, you can always go back in the video and adjust them and make them similar. Value area high, value area low, point of control. I don't worry about these. These are just in your way. All right. Inputs. These are my times. I do market to market, exchange, up, down. This isn't perfectly the end or open of the day, but I've just come to notice that the chart doesn't perform well unless you use these times. It will be overlapping with another one. So I do 17 to 17, custom up and down. I don't want to do total or delta. I want the up and down selling volume. I leave this alone at 70. It should be their preset. Extend POC right. You could do extend value area high right, whatever you want. But the POC becomes a draw on liquidity for later, okay? Just like a session high or a session low, when you see this range get overextended like this, I believe we will revisit these points of control, and these become support and resistance. Okay, so we have our chart VWAP. Let me add aggressor bubbles. Those are only going to be up in current price action. I just want to show examples of how. Look at this session, okay? So this is Wednesday night into Thursday. So prior to London, we had Asia. I don't know why Asia is not marked. It's just because it's too far back for my indicator that marks out session kill zones. This is an awesome kill zone indicator. If anyone is wondering what that is ICT kill zones and pivots. That is an awesome indicator. So map out London session. Here was our point of control. This was the largest participation of large shares being bought and sold at this level. Massive consolidation. Volume histogram is extending far right. Point of control line gets automatically drawn for us. That's the exact level where price was mostly, most participation happened, okay? What did we do? We broke from the point of control. My favorite trades are from the value area high or the value area low to the point of control or to the opposing point value area high. The reason I go to point of control is because look at this. If you were to have, trailed your stop all along through here, chances are you would have taken this one, gotten stopped out somewhere up here. These couple candles, I bet you there was some. If I didn't see imbalance either, I wouldn't have got in it. This could have been weak pressure, retracement, and right here, boom, displacement. That candle is going to have some pressure and some imbalances in it. So my stop would have been below the imbalance levels. And what do you know? I guarantee these didn't fully punch through the imbalances. All right. If you were to have made it all the way this close to your TP, I don't understand why people let their trades get almost to TP and then revert. That's foolish in my mind. So foolish to get break even when you were like 2 points away from take profit, dude. Trail your stop and close your fucking position, man. It makes no sense. You don't give money back to the market. You take your money, you screw. If you do this consistently, you will have a high win rate and a high R. I do that all the time. I have an average of 3.4 R or higher. And most people that are telling you to not do this have like a 1-to-1 R or a 1 to 1.5 R and like a 50 to 60% win rate. And they're over there preaching to you like, you're going to mess up your analytics. Like, dude, no. Take the money when you have the money. All right. You don't give it back. So either way, successful trade. If you had entered down here off of displacement levels, probably here or whatever, you could have been trailing up. You made it to VWAP. Say even you got stopped out here. I don't care. I don't care. If I entered here, my stop was here, and I entered here. Stop loss, say hypothetically, we had a buy pad right here, and I was targeting this. If I made it all the way up, say like this candle, this is where I would have been stopped out because we have this displacement. I bet you there was also imbalances on this level that got disrespected. So I would have already been trailing my stop up to, you know, these imbalance levels. What do you got? A 2.71 in that short of a range. Like, all right, keep targeting 1-to-1s. Doesn't make sense. Just learn new trading habits and you can get higher R rewards. But what I wanted to show you is how these become draws on liquidity, okay, for later times. We have this extended point of control out to the right. We know that price has now become inefficient. We have moved away. We've expanded from the range. Price is always seeking efficiency, and it wants to re-offer at low prices or what it considers a balanced price. That was here. Now it's confused. We're in a premium. We've expanded. Here's our current point of control. Where was the next spot that we visited? Bam, we gapped down and we smacked this point of control. That's our level. We swept these liquidity levels, but the safe take profit was here. You can target these, but over and over again, I'm finding session highs and lows a lot of time are failing in today's trades. You might hit them a couple times, but you're not going to hit them all the time. Okay, so we're down here, left a huge low volume node, ripped up to this low volume node, consolidated at this low volume node, visited this low volume node, low volume node, low volume node, low volume node. This was beautiful. Unbelievably great price action. But this was actually the day that I told you I'd taken a loss. I was anticipating a gap and crap based off of war news, and I was wrong. We reversed, and we are in bullish price action right now, witnessing one of the fastest recoveries in history. So yet again, we are now, this is why I believe we are going to at least return here. We left 5-minute relative equal lows. Point of control right around this 26,000 level is most likely going to become our new floor. We're probably going to wick below it, sweep this liquidity, and I wouldn't doubt if we punch right back up and use 26,000 as support. But as you can see by the aggressor bubbles, if you just zoom out, you can see how overwhelmingly bullish we are. Okay, and if you expand your chart, they're not as bad. They're not making your mind go crazy. So we also here have blown up above this value area high. These settings for my opening range breakout Fibonacci tool, what do you got there? Accumulation of shorts right at that pivot point. Institutions use pivot points, institutional traders, okay? So these are my settings. I mark the value area high to the value area low. These are the settings that I use. These are the fib levels that are most common. All right, you're going to have to tweak this. You can go back, pause this area of the video if you were interested, and go ahead and copy my settings if you would like. Do whatever colors you want, but you will just mark this is an opening range breakout fib levels. Match those to your predetermined value area high, value area low, and boom, what are we doing? But we're probably gonna visit this. Oh nope, never mind. probably gonna visit this. So regardless, I don't want to get too carried away here. It's the video has already been about an hour, so I really appreciate anybody that has spent time to watch this and join in on this, and I really hope this brings you value. If you would like, please join our Discord. It's completely free. I'm so sick and tired of watching people who are unprofitable in this trading space charging people absurd amounts of money to basically just go lose repeatedly in their groups. I love them all. There's awesome traders in this space, but I do believe it's become a trend of people trying to make the income off the people in the Discord or a community because they can't be successful in the trading. I'm completely different. Everything I have is completely free. I am successful with the trading and I make my living through this. But you know, later on, I do live trade in the Discord 2 days a week, completely free. The only thing that I offer, if you ever wanted to pay money, which I'm definitely the cheapest person in the space, is if you wanted to later on, you could pay $30 a month, essentially the price of a streaming service, to go ahead and hop in to the elite section, which is only a couple channels. The entire Discord has 90% of it is completely free. The only spaces that are, anyone that does go into the elite section, of course, you will get a little bit more attention from me, and you can have me over your shoulder like a coach. And if you follow along, you will see that my trades, I'm generally taking, you know, over $500 a trade. Some days right now in these markets, it's only $250 or $300 or something. But I really preach and teach discipline. Our Discord has a free trading playbook, free wealth blueprint, free this, that, and the other. And I just want to give you a brief show here. You'll get constant reminders of when we are live, when I'm running free education. There's also, all of this is free. News feeds, private party rooms for voice channels, free live trading floor, you know, general chat. You'll get updates, and you can go ahead and ask me anything you want. And every day, I post an incredibly deep market outlook. All right, it literally tells you the condition, and it's super accurate. It tells you mechanical squeeze, absorption divergence, but we are bullish neutral range expansion. I won't read you every single detail, but we go into the drawn liquidity, the volume profile insights, and it even gives you a risk assessment and recommendations. Okay, so what position size you should be taking, you know, regular standard position size or 0.25% position size. And I post this every day, all completely for free. There are news feeds for free that just get fed into here. Donald Trump's tweets that move markets get fed into here. There's just so much crypto news. If you have suggestions for our live streams that you want me to cover a subject or in a video and get more in depth about it, I'm here for you. Throw it in there and I'll do it completely out of my own time just because I want to help. Trade Logic live chat. I see this during any streams. If you guys wanted to communicate with me, you can on here or on YouTube, either one. And I won't keep going. This is the only area of the paid section. All right. It's very, very small because it is primarily free. I don't actually want your money. If you want me to be your coach, $30 a month, $1 a day is the least I'm willing to do it for. And I will be your personal coach for $1 a day. All right. That I think is so incredibly fair. Other people are charging, you know, $150 plus per month. So either way, I will let you guys go. I super appreciate anybody who actually finishes this video. Thank you very much. I hope this helps you. Please join our community. I'm trying to build the most lethal Discord community full of experienced traders that I do not take money from. So have a great rest of your night.